Hello, my friends. Welcome to Be the Boss of Your Money. I'm Mitch Goldberg, your host. We are getting on with the show, and thank you for your patience. You know what? I really mean to do this show at 4:30. Just a lot going on and so much news to take in. Calls. I have to say, from my perspective, the uh, the interest in that I feel for my own clientele, the interest in the planning process and updating things and knowing where the market is going, what's going on with people's accounts. It's actually a very good time, and I'm really excited about my industry. It's just a really good time for clients who have a strategy, an investment plan that works for them. Uh, it sounds obvious, right? Like everybody should have a strategy or an investment plan that works for them, but not everybody has that. It's not everybody is uh, on par with that. A lot of people are still wondering when the meme stocks are going to go back up. A lot of people are trying to make a quick buck in AI stocks, and on and on. And I always say this: we have more and better information and knowledge at our fingertips on our phones than ever before, but it hasn't made investors better off. And that's why I think it's really hard to manage your own assets. I'm not saying it's hard to be your own personal finance person, but investing is a different ballgame. For a lot of people, though, it is hard to manage your own finances because it's more than just a budget. As you get older, things become more complicated, and you have to start thinking in terms of beneficiary designations, estate planning. You have to think tax strategy, and that is a big topic that I've been on lately. I've been on this, talking to people about their Roth IRAs, Roth conversions. A lot of people are not taking advantage of the Roth option for their 401k plan at work. And I think people are shortchanging themselves. So I'm kind of on this kick to make sure people at least consider it. Taxes in retirement. If you think taxes in your working years is a big expense to you, wait till you're retired. Okay, it's going to be an even bigger expense, and that's what people are missing. Even if you're in a lower tax bracket, presumably because your retirement portfolio grew, you're still going to be paying more in taxes because of the volume of dollars, even if you're in a lower tax bracket. So it's not just, well, if you're in a lower tax bracket, you should put all of your money into a 401k or an IRA. The Roth could still make sense, but that's why you need to have a conversation with your advisor who knows your situation, and you could really logically walk you through the steps of how to decide. And if you don't have a financial advisor and you don't have a plan that's right for you, and you want to take this conversation, offline, just a one-on-one with me, I'd be happy to speak with you. Reach out, send me a DM, send me an email, give me a call, and we'll see if we're a good fit. Most of the time when people reach out to me, really, it's just they've got a quick question, or they want the reassurance to know if what they're doing is on the right track. And that's what they want. And that's fine. And then we go our separate way. And I'm just happy that people are taking the time to watch the show. That is very important to me, and it makes me feel good. I want to share my financial knowledge experience with you. I've been a financial advisor for over 3 decades now. So that is a really good thing. And sometimes people just keep me in the back of their mind. When I do need you, I'll give you a call. I just don't need you yet. And that's fine also. We're going to roll a quick intro because I should really do that like the first 30 seconds of the show. But I just want to finish the point that I'm trying to make. Let me pop up the social media icons. Hey, if you don't mind, give me a like in the live stream right now, or if you're watching in the replay, a like if you would please do so, a heart, an applause, a wow, depending on what reaction is available to you, depending on which social media platform you're watching on. It helps spread the word about the good work we're doing here. It's all about education to help you make your money work hard for you, because you're spending a lifetime working hard for your money. So here's the intro, and we're going to talk about the market, the winners of the day. One of them I think you'll find very surprising, and here we go. All right. Thank you so much for joining me. We're just getting started. You're watching Money in the Morning with Mitch. Oh my God. I'm so embarrassed. You could tell. You could tell this has been a long ass day. I'm just like Money in the Morning. That's my radio show. And that's part of the adjustment I'm making. That, like, I'm doing the radio show and then I'm doing the evening show, and I'm trying not to make them exactly the same. They're for different purposes. And I don't want to just repeat everything in the morning in the night. Plus, I'm much more comfortable here in the live stream. The morning radio show that I do that's also live. I will only do live. I told the radio station I'm either going live or I'm not doing it. I don't want to record. Well, people feel comfortable recording. If you make a mistake, say the wrong thing, we could edit it out, redo it. No. I don't have time for that. I just want to put the mic on and go. And when I hear the music, I end the show. As simple as that, right? It's not hard. You just talk about stuff. It's not hard, right? Depends. It's a good thing I'm not shy. What the hell were we talking about? Oh, yeah. Thank you. You're watching Be the Boss of Your Money with Mitch Goldberg. It's the afternoon market wrap-up with some personal finance, knowledge, and wisdom, all so you could make your money work so hard for you. So we had a bounce back in the market. We had, as of this morning, the Dow actually went down for 2023, gave up all the gains, down about 1%. After today, maybe it's down just a wee tiny little bit. The NASDAQ and S&P are still up on the year. NASDAQ is up about 8.8% on the year, maybe 9% now. S&P is up a little over 3% in the year. You can't invest directly into an index, but you could invest into a security that tracks or mimics an index, if you haven't heard me say that like 5,000 times. But today was not really an impressive bounce back after the drubbing that the market has been going through the last couple of weeks. I will tell you this, though. I don't like a giant snapback rally. If we have a really big rally, you're going to hear all the people who are bullish on TV say, you see, I told you everything's fine. We're going back. This is telling you that the Fed's going to cut rates or they're going to stop raising rates. Inflation is coming down. But in the last 2 weeks or so, 2.5 weeks, market's been going down on rising interest rate concerns, inflation concerns. All you have now all over the media is people saying, I told you this was a fake rally. I told you we're going to retest the lows. So when the market's down, we turn to the people who have their views reinforced by a down market. When the market's up, we see and hear people and read about people, their comments, who are reinforcing their optimistic view of the market. We should just corral everybody in a room and just say, what if we just tell you that we really don't know what direction the stock market is going to go in the short term? It depends on too many variables. And the smart thing to do is invest based on your time horizon, your risk tolerance, the timing until you need your money, your financial goals. And you'll be so much better off. Do you really care this morning if penny home sales had a pop last month? Because they're probably going to go back down anyway because interest rates, the 30-year mortgage rate started to pop up again the last couple of weeks. All these short-term little statistics that people make a big fuss about that they're hanging on to for dear life like it means something. And, I'm the only one who's going to tell you that not everything is meaningful. Not every statistic is worth stopping what you're doing to read all about it and then make changes in your portfolio, make changes in your financial plan, make changes in the direction of your life because you hear a new statistic come out. This is all noise. You could ignore it. The PCE, we've had a couple of things in the last couple of weeks which are starting to drive the market down. Up until a few weeks ago, stocks were going up. Inflation's going down. The Fed's going to pause. That means they're going to stop raising rates, maybe pivot, meaning lower rates by the end of the year. Then we got that whopping 517,000 new jobs created, okay, for the month of January. And then we got, in January, higher than expected retail sales. And then we got the consumer price index, CPI, was up more than expected. That's inflation, right? The PPI, producer price index, another inflation gauge, up more than expected. And this past Friday, the PCE, that's the Fed's preferred gauge of inflation, was up a good deal more than expected. And now we're just saying, you know what? The Fed's not going to pause this year. We're not going to get an interest rate hike till maybe 2024. Some people say 2025. And if the market has a snapback rally, then you'll hear people say, "Oh, the Fed's going to cut rates by the end of this year." You really don't know, and I'm tired of hearing and seeing people who tell you they know something, and then somebody will call me and say, "Oh, I hear the Fed's not going to cut rates," and then I hear the Fed is going to cut rates. If you have a point of view, look, the Fed is either going to cut rates this year, they're going to raise rates more this year, or they're going to get to a point where they're just going to be flat and leave rates alone. So if you have one of those opinions, there's a pretty good chance you'll be right, and you could crow about it and say, "Hey, I'm brilliant." It doesn't make you smarter. It just means you guessed right this time. Let me see you do that, that right guess 10 times in a row. I'm not knocking you, okay? We're friends here. We're on social media, and I'm just so much more comfortable, so much more comfortable doing this live stream with you than doing the radio show. I'm just getting comfortable with the radio show. It's still very impersonal. I know I'm told by the people at the station that radio is like so personal. It's theater of the mind. But something like getting here in front of you on video is really cool, and 2D image. So let's move on and take a look at a couple of things going on. Okay, you see the social media icons. You could connect with me. Any of these, I post all over the place. So just follow me on whichever one you feel best. I know a lot of people just want more YouTube subscribers. But don't worry, if you're not a YouTube subscriber, whatever, just, check out one of these social media places and follow me there. And you can reach out to me through those as well. I love hearing from you. Let's get rid of the social media icons now and put up screen number 4, and I'll pop myself up over here. Okay. So the Dow is up 72. It was off over 300 points on Friday, but it's off a lot. It was off like 4% last week. Not an impressive bounce back, but again, I don't want an impressive bounce back because when you get the big down swings and then the big up moves, they're followed by another down move. I prefer slow and steady, solid, durable gains like today. So it's not that I'm unimpressed with today's action, but I am impressed that with worries about rising rates and consistently strong inflation and worries that the Fed will not be able to cut rates for a long while and that they're going to even have to keep raising rates more than we expected, I'm just thrilled that the market hung in there. NASDAQ was up 72 points, up 0.6%. S&P up 0.31%. Gold up $7. It's, gold has been between like 1,800 and 2,000 for a while now. Oil was off a little bit, ever so little. I think oil is the big surprise. It's at the lower end of its trading range. Oil has been like low 70s to low 80s, so it's a little bit lower than the midpoint of that range. But we'll see how oil breaks. There's plenty of oil. We'll see. There's weather. There's geopolitical things. There's so many things that could affect oil aside from global economy, economic strength, and China reopening, et cetera. And we've been hearing about how China's reopening, and oil hasn't really done a whole hell of a lot. The 10-year yield 3.91%, backed off a little bit. Just so you know, the 30-year mortgage rate is tied to the 10-year yield. The VIX is cooperating, staying in the low 20s. It didn't spike up to like 30 or 40 in the last 2 weeks, which often happens when investors are worried about the market. So By the way, Menley is out there. I see you, Menley. Thank you for joining me. So the VIX is hanging in there, and it's basically telling you that there is not a lot of worry about interest rates in the market over the longer term. That I guess people, we all know that long term the market goes back up, recovers. So I think the more people let that sink in, the more comfortably are riding the ups and downs of the stock market, which is actually a bullish thing. It makes things less volatile, but that's why the VIX just hasn't gone up. So we'll see how it goes. Let's take a look at yields. Yields were down across the board. That's a favorable thing for the market. The 6-month and 1 year still slightly above 5%. The 3-month a little below 4%. So yields haven't come. They didn't go down a lot. They just, they went off. They dropped a little bit. Bond prices were up a little bit. When bond prices go up, these yields, you see the red, they go down a little bit. So no big deal. A little demand for bonds. No great shakes. Sector ETFs. Let's take a look. Consumer discretionary, winner of the day. Industrials, technology, building materials. The winners of the day are the economically sensitive areas. So are we going into a recession or are we not? People are trying to figure this out. I know this. Auto loan delinquencies are rising. Credit card delinquencies are rising, but they're still very low. They're still well below where they were pre-pandemic. And unemployment is not rising. If you see unemployment rise, and that is accompanied with a big jump in debt payment delinquencies, late fees, things like that, you'll see the economy slowing down. The market, I expect, will go up on that because it means the Federal Reserve is about to pivot and start cutting rates and start a whole new credit cycle again. And at the bottom was utilities, healthcare, consumer staples, the bottom three. So, the stuff that does well when you worry about an economic downturn actually did poorly today. So but it's a mixed message. And don't go by 1 day's worth of trading. There's a lot of mixed messages. We have a hero after the market closed, Zoom, okay? Zoom popping up over 6%, up over $4.50 a share. Much better earnings and revenues than expected. And now with the rising rate of earnings, you have to start to think about the PE ratio and that maybe it's not as high as you think because if the E in the earnings is going bigger, then the equation P divided by E is lower. So Zoom is the hero of the aftermarket, and the hero of the pre-market was this, Union Pacific. Union Pacific up almost $20 today. This is the railroad that had the chemical spill, the derailment in East Palestine, Pennsylvania. All over the news. Okay. The CEO stepping down. Stock is up 10%. And basically, it made back all of the losses it had from February 3rd, the day of the train wreck. It just goes to show you investors are looking past a tiny little area of environmental concern and contamination. Possibly, the NTSB is there. The area could be cleaned up. It's still pretty new. It's scary though if you live there. I'm not saying it's not. I'm not saying it's a bad thing. We're just talking about the stock now. But the stock has recovered. There's only a couple of railroad companies that are independent. This is one of them. Stock is coming right back. And there you go. So just when you think you have everything figured out, you don't. By the way, while you're watching this, if you want to ask me a question about what we're talking about or personal finance, investing, hit me up in the comments. I love hearing from you. And if you want to learn more about what I do, check out clientfirststrategy.com. That's clientfirststrategy.com. Okay, let's keep going. And just in other news, a rush of homes go under contract in January, but it's no big deal. We see penny home sales took a big jump because interest rates started to back off, but now they're starting to go up again. The home selling season starts Wednesday, March 1st. it's going to be really important the month of March to see how home sales go because so many things are tied to home sales. If you see stocks like Generac and Home Depot doing poorly, it's because they're worried about, investors are worried about home sales. And when people buy a home, there's so much that goes into it. People put so much money into their house, especially the first year or two. So we will see how that continues. So that's basically it. I don't really have any like magnificent directional call for you. It just we are stuck with worrying about inflation and interest rates, and until we get some kind of direction from that, we're going to be stuck here. Keep the faith, though. Don't stop investing because of the now situation. Don't worry about 2023. Let's worry about the year 2033. That's what we're investing for. We're not even going to remember this stuff, what happened today in the market. We're not going to remember this. You're not going to remember a thing that we spoke about today. But hopefully remember that Mitch is working his butt off to keep you invested for the long term in the appropriate strategy for your situation, because ultimately that is how we want to make progress. We're controlling the things that we can control, and we're forgetting everything else. I hope you have a great evening. Thank you so much for joining me. I will be back tomorrow at 4:30. Please tune in. And if you think of any questions or topics that you want me to talk about, let me know. Call me, text me, send me an email, send me a DM. And, the best content is the stuff that you ask about. I've been doing this over 30 years, guys. So when people ask me questions, I just bring the Q&A to you here, and you get to learn for yourself. That's what makes it such a good show, because I put real practical knowledge and questions that you have into this show. We're going to talk more about Roth IRAs, Roth IRA season, and all these incredible things that, it's IRA season, our tax season, all these great things that you need to know more about. So it's going to be a good show every single evening this week. So please make sure to tune in tomorrow. We're going to go through some real practical stuff. All right. Practical knowledge. Have a great night.